Hey guys, been a while coming. I know I've said that I would do up some videos for giving some tips about investing and just understanding money and economics and finance and whatnot over the years. Yeah, so I've stolen some time this afternoon to start a few of these videos. Obviously it's a big topic. I've got all your questions. There's probably about 50 or so that you guys have sent through over the last week or two. Yeah, so it'll take a few videos, but we'll try to punch through it. And obviously those videos will cover everything from technical analysis, fundamental analysis, what metrics you might use to look at a stock, you know, what money is, what effects currencies have on stocks, when's the right time to use debt. You guys have asked loads of questions and I'll try to get onto all of them and give my 2 cents on all of them. But yeah, I just appreciate the questions. Thanks for asking. I'm obviously pretty passionate about this topic. I think it's important for everyone to understand. I think understanding finance is one of those things that you probably don't want to outsource. As much as you might outsource parts of your financial life, maybe you want to go into exchange traded funds or mutual funds, managed funds, whatever you want to call them. At some point you've got to understand what you're doing, otherwise you're putting your capital and your money at risk. And yeah, I think the best investors understand what they're doing, and if you don't understand what you're doing, you're more likely to find yourself making emotional decisions when it comes to investing. When it comes to investing, you're looking to achieve an outcome or protect your wealth or hopefully grow your wealth, and you don't want to be doing that in an emotional state. So a good understanding, good foundation will help a lot when it comes to investing. And so for this first video, I thought what I might touch on is that nothing's riskless. All investment, every investment you make has risk. Even putting your money in the bank is a risk, whether you realize it or not. When you put money in a bank, you're actually becoming a depositor, which is a creditor of the bank, in the sense that you are giving the bank your money, they're giving you interest in return, they're lending it out for a premium. They've got all these liabilities and they owe you depositors your money back at some day, and they're hopefully making money with their customers. But if their customers default on them, they actually have quite a leveraged model, and that, you know, they don't need that many people to not pay them back or not pay them back the full amount, and all of a sudden that destroys their equity base. And this is what would matter if you were a bank shareholder. So as a bank shareholder, you share in the profits, but as a bank depositor, you just want your money back plus a little bit of interest. And you know, whether that's a good investment or obviously it depends on lots of things in terms of like what's inflation doing and stuff like that. And even money itself is not a fixed thing. I think a lot of people think that money is fixed, and I'll have to talk about that in another video. But so the point is that yeah, your money even in a bank is not necessarily safe. And as people talk about governments guaranteeing bank deposits and stuff like that, and that's true to a point, but that isn't necessarily always going to be true. And like for example, recently in Cyprus, which is a member of the EU, they had what was called a bail-in, in the sense that anyone who had money in a bank or their main banks, if you had more than $100,000 in that bank account, they actually took almost 50% of it, as my understanding is, and converted that deposit money into equity within the bank, as in they converted it into shares of the bank. Not, you weren't going to get the money back, you were going to get a shareholding in the bank. And you know, this is because they hit financial trouble, because their banks had actually lent a lot of money to the Greek government. So when they started defaulting, or they didn't pay back the full amount of money, that obviously flowed on and had an effect on the Cyprus banks. And so you'll find that, you know, it flows down the line. When people don't pay their money back, having your money in banks can be quite dangerous. I mean, it's not necessarily, yeah. So I guess what I'm trying to say here is a lot of people think that I don't want to invest in shares, or I don't want to invest in property, or I don't want to invest in commodities, gold, businesses, alternative investments, whether that's art, websites, domain names, whatever, because they perceive that as risky. And I'm sitting there thinking, from my perspective, like, nothing is riskless. So maybe the first rule of economics and finance is that there's always risk. It's just your job to try and find out what that risks are and what your downside risk is, and trying to understand that system, and not putting all your faith in anyone or any institution fully. And that's where we talk about diversification. I had a couple of questions about what is it, how best to go about it, and I'll obviously have to touch on that in another video as well, because it's a pretty big topic. But so I think for today, I just really wanted to say that, yeah, there's a lot more to it, and I think it's important for everyone to learn and understand. And there's a lot of instances recently where banks haven't necessarily paid back all their money. Yeah, so what happens in those situations, and it's happening in Greece recently, is that you can end up, when banks become insolvent and they really collapse the financial systems, governments will step in and they'll try to put capital controls in, because everyone wants to get their money out of the bank before they go bankrupt, obviously. But by pulling all your money out of the banking system, you actually accelerate the process. So what governments often do is they'll say, no, you can't pull out your money. So in Greece's case, I'm pretty sure they had a limit on how much money they could pull out every day. So they were, I think, limited to about 60 euros a day. It was the maximum they could pull out of the ATM. Didn't matter if you had $1 million in your bank, you couldn't pull out more than 60. You couldn't take those euros and spend them over in France or Germany. They were basically trapped within Greece until they restructured their banking system and recapitalized. And so, yeah, these are the things that can go wrong when you're investing in a bank, even when you're investing in bank shares or just depositing your money in a bank. So don't think that even putting your money in the bank is riskless. And I mean, I know in Iceland's case, it was a case of they had capital controls there for a number of years, and you know, you had your money invested, and I think a lot of the foreign depositors of Icelandic banks may not even got their money back. And obviously the currency then is, if you've got your money deposited in Iceland or Greece uses the euro, Iceland uses the Icelandic krona, is that you often find that after these banking crises, because governments have to get involved, and often they may have to create new money, normally monetary base, to inject it into their banking system to recapitalize their banks, and to allow the banks then to begin lending again, because so many people operate their businesses on credit and people live on credit, and it's an important function of society. But what you find is when, you know, everything's a supply and demand, like prices, if there's a shortage of anything, prices tend to go up. If there's an oversupply, prices go down. And so when governments come along and they pump money into their economy, printed or created, well, money itself is a whole other conversation, but the point is that the supply of money may increase, and often the value of that currency can go down a lot. So the Icelandic krona dropped by, I think, over 50% through this process of their financial crisis, where they need to recapitalize their banks. And that's the process that normally needs to happen in economies when these things happen, because obviously you have a financial crisis when you're living beyond your means or making bad investments, and the way to correct that is spending less. So when you're talking currency terms, which is a complicated topic in and of itself, but basically if your economy is becoming less productive over time because you're investing poorly, your currency tends to drop. And so when you go through these crises, you need to have a falling currency so you can focus on stop buying imported goods off foreigners and increasing your exports, and all these little things that we can talk about in another video. But I guess the main point of this video is I want to say that there is no investment that is riskless. What you're trying to do is just work out what the risks are and then assess them and make a prudent judgment as to whether this is the investment for you. I don't want to leave you there thinking that nothing's safe, and everyone's got to make decisions about their investments and where they're going to keep their money and how they're going to store their wealth, because the objective is obviously to be able to take that money and be able to spend it someday in the future to buy your goods and services that you want for your life, whether that's cars, houses, phones, or starting a new business. So I think, at least, so I'm obviously Australian, but I try to keep an eye on the whole world, and particularly China, Europe, and Japan, and the US being the biggest markets in the world, and they really move the global economy, and everyone's playing their part in this big global market. Is that if I was depositing money in a bank and I was worried that, oh, will I get my money back? The things to look out for, and the advice I've given to my family, is that, hey, look, most of the banking systems around the world, if you watch, say, bank stock prices, because that's the equity, so there's a hierarchy of stakeholders in any companies, and you have senior secured creditors and unsecured creditors and preferred stockholders and equity holders, and we can talk about that in another video, and what the value of each of those tranches can be, and they do vary, and the rewards you get from being one of those classes is normally different. Like in the top position, being a senior secured creditor might be the lowest return but the safest, whereas the shareholders are normally, the equity shareholders, like we're talking about stocks or shares, often get the highest returns. They're shareholders they share in the profits, or the profits of those companies. The value of those, each of those instruments has a different level of volatility. So if you were depositing your money in a bank and you wanted to know that you're going to get it back 6 months, 12 months from now, I'd be keeping an eye on things like bank stock prices. So as in, if say Commonwealth Bank in Australia, which is the biggest bank in Australia, as I understand it, share price currently is floating between $80 and $90. If that was to start falling down to 50, 60, maybe even down to $30, I'd be starting to think, okay, the banking system might be in a little bit of trouble. I want to start diversifying. If you've got $10,000, maybe you don't need to, but if you've got $100,000 deposited in the banks, as much as the government might guarantee those deposits, you might want to start going, oh, okay, I might want to put some money in Commonwealth Bank, some in Westpac, and maybe you might open a foreign bank account, maybe in Singapore or Hong Kong or something, and just say, hey, I'm just going to keep a foreign currency account just in case that I want $10,000 for my rainy day if there is capital controls in Australia, or something like that. So you can diversify within bank deposits as well, and across different banks, and even currency itself. Like, currencies are volatile, and so you sort of want different exposures at times, to ensuring that you always have access to capital and cash. Because I feel like when it comes to investing, you always want to be investing from a position of power, in the sense that, like in any negotiation, if you don't have a lot of power in that negotiation, you're always going to get a bad deal. So in the game of investing, it's the old saying, he with the gold makes the rules. It's like, if you've got cash when no one else has cash, that's when you're going to get the best bargains. You look at the great investors like Warren Buffett. It's like they keep cash on hand all the time, because you never know when a fire sale is going to happen in stock markets or in bond markets or whatever, and you need to be ready for that. The part of being ready for that is, one, understanding how that system works, and two, just having cash on hand to be able to deploy it as required. And don't expect, I don't think you should ever depend on a system working all the time, and whether it's government or financial systems. You want to be taking the approach of, hey, look, I don't want to keep all my eggs in one basket. I want to think, okay, what could go wrong? How would it go wrong? How can I protect myself for it? Or how can I even profit from things going wrong for other people? And that's what the great investors do. They know not just when to buy, they know when to sell, and patience and preparation what really make you great at investing. Yeah, I think I've said a fair bit there, so I'll leave it at that for this video. Just wanted to open your mind to the concept that nothing's riskless. Money in a bank in itself is still risky.